If you're thinking about allocating capital to the banking sector because the economy is doing better, you've got the interest rates potentially increasing, but you also heard in recent weeks and months this little thing called inflation rearing its ugly head, and you want to know what's the impact across the banking sector, as well as across different flavors of banks, such as your consumer banks and your investment banks, then stick around. This video is for you. You might be thinking, for instance, okay, they trade at 12 to 13 times when the broader market is trading closer to 22 to 23 times, so it seems like potentially a cheap way to hedge against inflationary pressures and act as a hedge to your growth portfolio. Or is it? If you're new to the channel, I go by 10bagger. I'm a 27-year-old self-made millionaire investor who happens to love growth, but at this point in time has a large holding in the financial sector for reasons I will get into. This also serves as your official disclosure statement. You have been warned. First, I'm going to try to untangle the relationship between interest rates and inflation in a hopefully non-confusing way for you guys, and then we're going to dive specifically into the banks. All right, the first thing you should know between interest rates and inflation is that there is a cause and effect relationship here. The Fed cannot directly manipulate the rate of inflation, right? It is a byproduct to policy changes to the interest rate. Now, in terms of the Fed's power, they can only manipulate the short end of the curve via the Fed funds rate, as well as increasing the money supply. The longer end of the curve,
I would say the bond gods control longer term rates.
These guys said it, not me. The second thing you should know is that it's typically undesirable. It erodes the purchasing power of your hard-earned dollar, which means you have to pay more for everything from groceries to your Netflix subscription. The other thing to keep in mind is that if you're an investor, inflation will hurt your stock valuations. You probably saw this in the past weeks or so, and generally speaking, it does impact growth stocks about 3x that of traditional S&P or value stocks. Not super scientific, just what I've observed. So if inflation is deemed too high or runs hot for too long, then getting back to our cause and effect relationship, the Fed will actually increase the short end of the curve or short-term interest rates to increase credit costs, increase borrowing costs, which will in turn put a damper on economic growth. Now, the other thing you should know is that there's a flip side to this equation, right? Inflation is not binary. It in fact exists in this sort of Goldilocks spectrum. If inflation is too low, then yes, your purchasing power is maintained, but the economy is more likely to grow slower. Wage growth, job creation, all these take a hit. And if you remember, the Fed has dual mandates, right? It's both keeping the inflation rate in check, ideally around 2%, but below that as well, but also maximum employment. And what we saw for the majority of the late 2010s is that job creation and wage growth has largely been stagnant, which is why the Fed has changed up its playbook by keeping rates lower for longer, at least till the end of 2022 or early 2023. That being said, low rates cannot persist forever, right? Some of these wild inflation prints that we're seeing that hit disproportionately lower income households, such as the price of groceries, commodities, or especially lumber, are indicative of the fact that inflation needs to be contained. The Fed is conscious of the economy potentially overheating, or so we think, and they have telegraphed their intent to raise interest rates on the short term by 2022 or 2023. Now, investors get this, right? And they're making moves well ahead of the Fed's telegraphed intentions. As the economy improves, as reopening plays materialize, there's been a move out of bonds. So they're selling bonds, which in turn puts upward pressure on the yields and rotating into stocks. And that is what's causing the steepening that you're seeing in the 10-year. Taken together, it is this improvement in investor sentiment combined with the Fed's telegraphed intention to increase rates that has caused the rise of the 10-year yield. And that is the metric that you should be paying attention. So whenever we think about the effect of inflation on the financial sector, it's more important to think about the impact on the interest rates, because that will ultimately drive the lion's share of the price prediction and appreciation within this sector. Now, because all banks earn some degree of interest income, that is the spread between products such as mortgages, CDs, savings, loans, they generally benefit from this move. If you're an ETF investor and you're thinking, okay, so that's relationship between inflation and interest rates, it benefits financials, I'm done watching the video, I can just hold my VFH or XLF, then I guess you're absolutely right. But if you're more of a single stock investor such as myself, there are some other permutations we should talk about. The first is that this benefit is most pronounced in your traditional lending and depository institutions, right? Think the consumer banks. If the institution you're looking at is like a Goldman Sachs or Morgan Stanley, where they have a large, robust capital markets division, then they're generally speaking better hedged to fluctuations or changes adversely to the consumer bank in terms of the interest rates. So if you have a large leverage finance or debt capital markets team, for instance, when interest rates are low, you might see more customers looking to refinance a loan, take out debt to support an acquisition. So that bank will, generally speaking, receive a lot more fee income to offset some of the weakness in the consumer bank. There are actually several other permutations here, so let's go through them one by one. All right, so if rates increase, then banks make more money on the spread between loans and deposits, right? So that benefits your consumer banks. If rates stay the same and the economy continues to do well, then so do the banks, kind of like market perform. If rates retreat, then robust debt issuance and loan demand helps the banks as well. This is less true for Wells Fargo with the asset cap in place, but is generally the case for both consumer and investment banks alike. Lower rates are also more likely to support robust equity capital markets activities such as IPOs, direct listings, and SPACs. And if the market is volatile, then bank trading desks should generate more in commissions. Again, this benefits more the investment banks and the consumer banks, but there's just a ton of ways to win, right? If you're invested in this sector and the economy, generally speaking, is doing well. At the end of the day, it's up to you to choose your exposure, right? If you want higher beta against inflation and interest rate and you want potentially higher returns, or if you have a belief in inflation or interest rates and you just want the purest expression of that in your returns, then go for the consumer banks. If you want to play it a little bit more safe, then the investment banks are probably a better bet for you. As long as the economy is growing and improving, 9 times out of 10, you will make money as an investor. Now, there are other areas that you can benefit from an inflationary environment, right? Such as REITs, TIPS, and gold. But generally speaking, it's hard to do better than the banks. It's one of the best inflation plays. And if you watch this far in the video, you owe it to yourself to add some to your portfolio. All right, in the last part of this video, for those who are interested, I thought I would just touch on my 2 favorite sector picks within financials. The first is Goldman Sachs. They trade at a analyst consensus price to earnings forward multiple of 8 times earnings, which is stupid low. But the thing to keep in mind is that these are analyst consensus estimates, right? What do? They always outperform. Their Q1 2021 earnings per share was $18.60 compared to the consensus of $10.22, demolishing that estimate by a mile. Now, if you annualize the $18.60 per share, you'll get actually somewhere in the ballpark of between $72 to $75 per share of pure earnings per year. And if the stock right now trades between $360 to $370, that's just a 5x multiple, right? Compared to that 22x multiple in the market and the 10x, which quote unquote shitty banks such as Wells Fargo routinely trade. And guys, there's just so much quote unquote value for a name that has, despite running up 80%, right, in a short time frame of just 6 months, there's still a lot of value here. I think it's because they went from out of favor to investable, but I don't think investors are still fully giving Goldman credit for just how much more it has to run. I saw this with Blackstone back in 2013, 2014, right? Blackstone tended to trade at a discount to peers such as BlackRock and T. Rowe Price, which I argued were sleepier firms, because investors didn't like the concept of paying anything above a shitty multiple for performance fees. Now, keep in mind, Blackstone always performs, right? Some quarters they'll be popping DPs, some quarters they'll be parting it up and popping AP, but regardless, they're always popping champagne. So with Goldman, performance is becoming more predictable. So I would expect whatever discount that they trade now based on any uncertainty in their trading or their investment banking division to disappear over time as investors get accustomed to that level of performance. If not, the bank is still stupid cheap, right? At between 5 to 8 times forward earning. Now, the second one is Wells. I've covered this one extensively in a separate video over here. So if you're subscribed to the channel, I don't want to bore you guys with this, but it just has so many catalysts, right? Between the asset cap getting lifted, the expense synergies, the normalization of legal and professional expenses, which by the way, nobody is talking about, as well as reinstating a higher dividend to get those divvy investors back in vogue with the stock. There's just so many ways to win, right? Wells will also be added to the iShares Momentum Index at the end of this month. So if you're watching this video and this video was shot in late May, then there's a good chance that they'll be beneficiaries of the largest momentum index being rebalanced. But generally speaking, there's just a ton of catalysts, which is why I'm super bullish on that pick. If you saw that video, I had a price target of $65 back when it was trading at 42. As of recording this video, it's now in the 47. So that's a great return for some of you guys. For full disclosure, I have 6-figure positions in both, and I don't expect that to change anytime soon. All right, guys, I hope that was helpful for you. Where are you invested in terms of the sector? I'd love to know in the comments below. Thanks for watching. As always, nothing is more important than your time, except for maybe your money, and I hope to catch you on the next one. Peace.